giving up on that bullish market, and it's actually getting ready now for a bearish regime, which is the worst possible thing for OPEC, because they've got a bearish sentiment being acted out where people are willing to get net short on every month in the forward curve and willing to see this through. And the weight of that sell side positioning and the weight of that momentum with sentiment creates a lot of downward momentum. And how do you arrest it? Well, you're going to need a new narrative, and OPEC don't have any narratives left. Hello again, welcome to another market episode of World of Oil Derivatives. I'm Greg Newman, Group Chief Executive of Onyx Capital Group, joined with the usual Vincent and Martha. And today we have return of the Jorge in place of James Brody, who's stuck on a train. That's the only reason you're invited, Jorge.
Thank you.
We like your opinions a lot. So I also want to mention before we get cracking that Jorge has led an initiative called The Officials, which is a benchmark for derivatives. I'll let him go into a bit more detail on that today. But it's an exciting new thing that Onyx are offering. And of course, it plays to exactly Jorge's skill set and what made his career so successful. So it's going to be really interesting. I reckon for the audience, what's on everyone's lips, what's on everyone's minds, OPEC, of course. I think not so much a surprise announcement, but the market is reacting quite considerably. So I think we just dive straight into that. Who wants to set us off? Martha, could you just give us like a summary of what happened on the weekend?
On the weekend, OPEC met in person in the end to have a bit more of a threatening atmosphere, one may say. And the outcome of this was that the 2.2 million barrel per day cuts, the voluntary cuts, were going to continue from the end of June to the end of September, with the option to gradually phase cuts over 12 months from October to September. And the individual cuts and like being brought back on was kind of broken down country by country. And the UAE, who have historically been very kind of standing up and saying, you know, we want to have production availability, they've come out as basically the big winner of everything. Mm-hmm. So they can gradually raise their production by 0.3 million barrels per day, up from the current level of 2.9 million barrels a day. So
this is the initial kind of extension of the cuts. And then we also have the next year, into 2025, September, there's the option to slowly bring back production. So that is echoing 2021, I guess 18 months from 2020 to 2021, and which actually never ended. The production that was meant to come back online never fully did. And if anything, they cut back again from 2022 onwards, despite the war. So they had their chance, I would say, at peak 2022 to bring back. They didn't. So they're in a perpetual state of cutting whilst the market's vulnerable. So I think that's the first thing. Second thing I think Jorge's desperate to say is they are producing more than they were saying anyway. So could we start with that? Like, what's your thoughts on that?
There is the official narrative by OPEC, the official statements, what the press, in a way, repeats what OPEC says, and also what the trade says, and they all kind of coalesce around the official line about what the production is and what the cuts are and whether it's going to resume at some later point. But then one needs to focus in the reality. And the reality is that Iraq has been overproducing by close to 700,000 barrels a day. The other reality is that ADNOC has been overproducing for years. And they even mix things like condensate into Murban to essentially, in a way, pretend that they're respecting the OPEC guidelines. So there is what you think there is, and then there is the reality.
Sorry, would it not be Murban into condensate?
No, it's condensates into Murban to fluff up the amount of Murban being sold, which then gets sold into the windows.
But I thought the whole point is to say they're producing less crude.
No, they're producing more.
But surely you'd want to... Oh, you're saying in the open market that's what they're doing?
Yes.
Okay, fine. Yeah.
So they're mixing other streams into Murban, so Murban grows. But then if somebody questions, they said we are not, because condensates is outside of the OPEC guidelines. So in a way, it's a little bit of smoke and mirrors, but the market reacts to the actual production. And the production by OPEC is high. Russia always says we're going to align as a member of the OPEC Plus, and we're going to reduce production. And then when you see the results by Rosneft, they were spectacular in Q1. Why? Because they were producing a lot of crude. And then there are, of course, the countries that believe that the sanctions work, and of course they don't. The oil gets out. So the market has been oversupplied. Some production has been cut back by, so to speak, the good members of OPEC, Saudi Arabia and Kuwait. But whatever they reduce, immediately the US compensates by more shale production coming out. So at the end of the day, this market has been long for a while. People like myself have been bullish initially in the year because I was expecting the Chinese economy to overperform.
Yeah, and it's underperformed. But I think it's actually overperforming now, contrary to people's expectations, or at least it started off bullish, corrected to the downside, and overly bearish. And I think it's more bullish than people are saying. I think there's evidence of that.
But this gets overwhelmed by the US starting to underperform. So
that's the macro demand side. But just on your point about US, I think the other thing, because I'm just, there's the beauty of this podcast, week on week, we're iterating. And I think the Guyana story has been huge, right? Like we've talked about that a lot. And I think 650,000 barrels odd, I think, from memory.
Yes.
I think it's more the non-OPEC and not non-US has surprised. Last year, it was the US that surprised to the upside production-wise. I think this year it's a lot more non, and Venezuela for times.
Yes.
And so I don't think US is actually as much to blame this time personally, but it's a bit of a side point because it's still the same point you're making.
Yeah, the point is also the US economy. And what a lot of people tend to forget is the US elections.
No one forgets about that. It's all anyone ever talks about. I know what you mean in the context of like
of the broader macro, so to speak, is the US is desperate for an oil price.
Yeah.
And it will do what it has to make sure that the oil price is low. I'm sure you guys spoke a few weeks ago about the release of the product inventories from the Northeast to make sure that during the recent holidays, Labor weekend, there was plentiful supplies and a low price.
But we were also saying, do you want to just butt in there, Martha? Because it was...
Yeah, kind of it been arranged for so long that it has kind of spun into being that kind of narrative of we're going to ease the supply issue and we're going to help price at the pump, which the price at the pump is really low right now, I think, and it's going to keep decreasing if we keep seeing this trend with the rubber. It's going to keep decreasing until like July the 4th, which I think is going to be, really good for the Democrats. But I think the release of this stock was just because it has been sitting there since Sandy, and it would cost $100 million more to maintain it there than to sell it, than it was even worth. And that space could be used to store crude, I think, a lot better, and less costs for storing crude there instead.
Yeah, it makes sense, but then there is the timing. And the timing was uncanny for the Labor weekend. So it's politics at the end of the day, right? And the reality is where we are right now. The market finally woke up to the facts that the market is long. Economies are not performing as strongly as they should on a macro total basis. Mm-hmm. And the war premium has disappeared. And now, very soon, it looks like we could be in the mid-70s as a market before we see another reset should we go long from here. But at the moment, we're still heading down. And I have been actually being a little bit cheeky with my friends, talking about, cloudy with a chance for meatballs. And I think it's a lot of actual tomato sauce falling. And this is the reason I decided to put on a red shirt today, to make sure that I fit in the overall narrative. It's a lot of blood on the street. A lot of billions were lost in the past couple of days. And as I observed the markets, and I told this to some of my friends in the trade, I couldn't understand why the market decided to go a little bit long Tuesday and Wednesday of last week, because it made no sense. OPEC had essentially two outcomes, stability or down. There was no possibility of the price going up. And of the two, the most likely was going down, because the mere fact that they had to meet in person meant that the agreement was falling apart. They're fighting a lot.
And this is not new. I think it was something that we had been talking about a lot last year, which is that, like I said at the beginning, with the time to bring back full production was the peak 2022. I think they got greedy. I think enjoying the $100 per barrel plus and thought, let's ride this. But once you then have a sell-off, it's very hard to then bring back production once you have a sell-off, because then you're adding to the sentiment and it can be disastrous. So we're seeing the flip side now on the US side. So they bring back oil from the SPR to create a downward sentiment. They could have been squeezed, and it looked like it was going to happen for a time. Now we've heard this morning they're coming out and buying 3 million barrels. They've been buying 38 million barrels, I think, this year, which is a perfect time to do it, because we've got bearish sentiment. The market looks like it's giving way. Them buying, it's questionable whether it's going to have a material impact on the physical at all, but it certainly doesn't. I don't think it will hurt such a storm of bearish sentiment. And that's the bit. So you've given a very good summary of how the typical fundamentalist will look at it, right? Yeah. And that is well-trodden path. So I think there's a decent amount of understanding there, but we like to talk a lot about sentiment, right, and trading. And ultimately, the thing that I would contest is last week, being long at low 80s actually seemed quite an interesting prospect, because we had unraveling of positions aggressively, right? So the longs were coming off a lot in Brent, shorts were being increased, the CTAs were getting short with the momentum, and there was net short positioning and managed money for the first time in a long time, and it was getting very, very short. I think WTI was slightly more long, but the point is that the market had been thrown a hell of a lot of flow on the sell side, and it absorbed it, and it was stabilizing despite the underlying markets dated Brent, time spreads all collapsing. The outright price was holding. So probably was on the expectation, or the hope, I should say better, on something coming out of the OPEC meeting that would support prices. So now they're probably stopping out of that now, would be my guess. Similar to Israel-Palestine situation. Yeah. People were long into that as a kind of to protect against upside risk, to also make money, being long, and they had to stop out of it. And that was, it feels like a very similar situation, you could say. But I just want to go back to this game, the getting 12 people in a room. And I love talking about that. Paul Tudor Jones, legendary trader. So he came out with a documentary called Trader, and you can still get it. I think he tried to buy it all up and stop people seeing it, but it's out there now and you can't. And it was in the 1980s. You can get it on YouTube. But one of the early scenes is him talking about OPEC. And he's is the pit trading days. You give your order down into the pit, and he says, basically, I'm gonna sell into this, because like there's 12 men who need to get in a room and decide something. Wild horses can't stop me betting against that. So he starts, like, people are anticipating what the OPEC are saying in their meeting, and he goes out and sells a couple thousand lots, and he gets a call from BP being like, oh, someone's out there selling the shit out of this, and he goes, I hope they think it's the Arabs. I think that I hope they think that something's going on. So he basically just like played on the sentiment, played on the unlikelihood that these kind of powerful men all together would agree something. And I think that's never changed. I mean, they did manage to agree in 2020, but only after a deeply impactful price war. And that was the negative oil prices in WTI were needed to get Russia to the table with Saudis to agree something. And then, okay, they finally agree in extreme scenarios. But as you said, Martha, like Abu Dhabi have been fighting ever since to get back. And that's been very, very public. So if you're constantly trying to keep people together, Saudis have gone into their own pockets so much that they're probably quite annoyed with the Russians recently. That got a bit of media, like it looks like they've been overproducing and found out. Saudis think I'm holding up the bucket here, like someone else has got to get involved. So it looks like this time around Russia did actually dip into their own pockets as well. Saudis like I've done as much as I possibly can, and as you said, Martha, ADNOC are allowed to increase more, which is a clear concession that it's, as you said, Jorge, it's not really going well in terms of the conversations.
And in the past, we have seen similar situations where the Saudis cut back a lot and the rest have absolutely no discipline whatsoever. And at some point, the Saudis go, okay, enough. If nobody is having any discipline, neither will I. And they just let the market go. And as the market corrects, then the other members eventually.
But they haven't done that in 5 years.
No, they haven't.
And why is that?
Because Saudi Arabia is more and more indebted.
Yeah.
And they had to sell debt, which went well. They also had to sell part of Aramco, and that also went well. So they have other sources of funding. But the reality is their budget is getting heavily overstressed. So if the prices drop a lot, their bonds will suffer. Their plans for NEOM, or new home as I like to call it, will start suffering. So they're also getting caught by their own money needs.
And they've lost their chip at the poker table, because that was one of the things we were afraid that they can say to their peers, we will throw a lot of oil at the market. Now people don't believe they will. So they've lost that bargaining tool.
Except they still need to make money. And when you...
No, that's what I'm saying. Everyone knows they can't afford to flood the market. So they're not afraid of it. So you can squeeze them and say, well, I'm bringing back production. What are you going to do about it? You see what I mean?
I have a slightly different interpretation. Is if they get very stressed regarding money flows, they will sell what they have to just to get the incremental dollar. So to me, I still see that as a...
Sorry, you mean they'll so they're 10 at the moment, they'll produce 12 or even 12 and a half.
They cannot go to 12 and a half, but they could go easily to 11 and a half.
And 11. Hope that even though they're selling at like $50 a barrel, it will offset.
Yeah, correct. Or because they just do need the money, right?
No, I get it, but I'm saying, as you said, that hurts the future earning potential of Aramco, the bonds.
Yes. But when you have to raise money, and they already did dip into the bond market and into the Aramco shares. If they need additional money, what is the other source of funding you have to sell more crude, right? So we need to monitor how the budget for Saudi Arabia is going. And if it's too stretching the need for money, they will sell, regardless of the consequences to the oil price. And then the other members will need to get the discipline. So we're still at risk, I think.
No, fair enough. Also, Oil Leaders is a book, Ibrahim Al-Mahana, if that's how you say his name correctly. It's a fascinating book. I don't think it's very well read, and it should be, because he openly talks about the Saudi strategy when he was involved in implementing that strategy. And I love some of the quotes in it. It's like, the market moves by fundamentals, yes, but sometimes even more importantly by market sentiment. And we go on campaigns and we talk to the FT and we talk to people about trying to create a narrative. And it's basically, a narrative is only as good as people are willing to believe it. You've got an industry that wants to be bullish. Everyone does well out of a bullish market apart from the end user. So it's a situation where people are very willing believers of OPEC strategy. But the problem with any propped up market and any propped up narrative, when it eventually does give way, it gives way big time.
Yes.
And it's just kicking the can down the road more and more and more, just like your fiscal entrapment point with treasuries and all that. Bubbles are bubbles at the end of the day. And this is a form of bubble. So what I would say this time is that we did have a market was bullish. We were bullish. Signals were bullish at the beginning of the year. Margins were fantastic. For refinery margins were fantastic. And all ironically, because actually what made refinery margins fantastic? Well, people bought the hell out of Q3 product cracks. That dragged up the whole curve. That improved the refinery economics. Refinery margins hedge it and they produce as much as they can. Refinery margins then go back down. So essentially the oil traders just gave the market money essentially, or even gave it back to the end users for once, I guess. But the point is that it looks like this whole year has been a bit of a fight for sentiment and an around the corner bullish attitude. But it was the dated Brent market that collapsed so aggressively so quickly, only April, right? Only considerably in April after being bullish for so long. And it's been so persistently weak that just all of a sudden, kind of chickens have come home to roost. But this is the age-old argument that we always bang on about, which is physical versus sentiment. So how does the physical market impact the outright price? Well, in short, it can only impact it by $1 a barrel or $2 or $3 based on physical pricing. That's how it works. So what you really need to see is persistent physical price weakness in the face of bullish sentiment, that eventually that narrative just loses its teeth and loses its weight, and then eventually people give way, which looks like it's happening right now. And I think even the last bull trader right now is thinking, this just looks like it's not going to happen. And I think a way to back that up is the dated Brent market. You know, people were selling the very front and keeping their length at the back. The rolls were therefore deeply negative. Everyone's selling every month now, and there's a bearish momentum trend, which makes me think that it's not a give up. Well, yeah, it's giving up on that bullish market, and it's actually getting ready now for a bearish regime, which is the worst possible thing for OPEC, because they've got a bearish sentiment being acted out where people are willing to get net short on every month in the forward curve and willing to see this through. And the weight of that sell side positioning and the weight of that momentum with sentiment creates a lot of downward momentum. And how do you arrest it? Well, you're going to need a new narrative, and OPEC don't have any narratives left. So that's where we're at. Why are you smiling?
No, because
you love drama, basically. You love.
Hence, I'm repeating myself here. Hence the shirt. But we shouldn't forget that there is nothing like low prices to cure low prices.
Yeah.
And as the economy falters, as the expectations of a drop in interest rates are really proven wrong, because if there is anything, it'll be a minor one, then the economy needs lower commodity prices to
ease
get
inflation.
kick-started.
You're absolutely right. Yeah, no, fair point.
And we need to go through those waves. And as you mentioned, right now, I think we're entering we have entered actually quite decisively a bearish tone to the market. And we in the launch of the officials that we did on volume 1, we stuck our opinion out and said that the market was very bearish. So we will be not shy to say what we think, making sure that there is an independent voice, that everything is done very separately within the Onyx context. And at the moment, I would say we're bearish. We are seeing markets hitting even 74, if not 72, of course, with some corrections in between, which may be happening quite soon, actually. But the market is fundamentally long.
So to give us a bit more context about where we go now, Vincent, the state of the market, what about CFTC and stocks then? We talked a bit about SPR, but what else?
So on the CFTC side, ahead of the OPEC meeting, speculators were more risk off in Brent, clearly with long positions and money managers declining for 5 of the last 6 weeks. But it is interesting because on an overall basis, there's been more money manager longs going into WTI over the past 2 weeks, which has been quite bullish for WTI Brent. Perhaps a reflection of a more bullish view in US fundamentals around Cushing, where US has seen stock draws per the EIA stats, but also a reflection of the reduced geopolitical premium in Brent, specifically around the Middle East tensions as well, and perhaps weakness in the North Sea. So recently it's an interesting one because something that's came out recently is we've been looking at money manager net positioning as a function of overall total open interest, and it seems that from last week's CFTC, were of course net positioning had been declining, but there was further capacity for that net position to decrease further, in the sense that at $81. From a capacity perspective, there was more risk for prices to come off, which is exactly what happened. Yeah. But it's also getting onto the lower side, which means, okay, the market might be a bit more saturated to the short side. So in a sense, yes, flat prices below 80, but maybe there might not be room to go much further below. That's a very valid point,
because do you remember James Brody was talking a lot about this with the CTA positionings? We were actually looking at the net CTA position with our model, and it was heading towards flat, if you remember, is in the flat positioning net, but still a downward. It was still causing downward momentum because it was going from long to short, and the kind of the CTA, I guess, were catching up with each other. But we were saying, remember, what if they now get net short? That's a hell of a lot of hundreds of thousands of lots, millions, hundreds of millions of barrels of volume to be sold into Brent and WTI. that could drive it a hell of a lot lower. So I couldn't agree more. But I think we're probably a while away from that. But I see your point. It's now flipping to, okay, when do we see the saturation point if everyone's now not long and getting short? So that's a very valid point, I think. So refinery margins, Martha, I think this has been the theme. So again, big article from Bloomberg at the beginning of the year, people getting excited about product cracks because Brent doesn't look very interesting. People very long the refinery margin essentially. And as I mentioned before, I think it's quite clear that had the impact of speculative money propping up a refinery market, which was perfect for refiners. And they've come in and just completely benefited from that. And can you just speak about that in the US and also like where we're at now with margins in general?
We were coming from a place at the refinery margins where the utilization of the States is extraordinarily high. We saw an increase last week of over 3%, and it's up to 94.3% totally, and PAD 3 is at 94.6%. So that's really important for gasoline, of course. Rate runs are incredibly high, which means that exports also need to be kept up at these incredibly high levels. The draw in Cushing and crude last week for the week ending 24th of May was kind of reassuring, as you've seen the week before we were saying that production is out of control. You know, they can't be exporting all of this. The refineries can't keep up. But this week showed that, you know, maybe they can, maybe this isn't going to be a constant problem, but it does put them in, I think the word would be precarious. I think the position that they are in the States with this incredible production is extremely precarious. And I think there just isn't that demand that everyone was expecting to see in gasoline to keep up. Gasoline, as you said, it was this bubble. This Q3 strength was being dragged up, and then it was undermined, and it's just completely lost everything. And I think there has been, you know, little bits of strength or little bits of things that people could maybe say, oh, there's that, or there's that, but it's just not enough. And it seems that players just, we've seen, I think, 7 weeks in total, CFTC open interest dropping. I think players just aren't willing to risk it again. I think so many people were burnt, and they don't want to risk it again until they see that big headline story, until we see a hurricane, or until we see like proper we're seeing really bad heat waves in loads of the States at the moment. And I think that could take a lot of refineries offline. I think especially with the rate so high, like if run rates are really, really high, then that increases the chance of, you know, optimization being off, and it increases the chance of having to shut down the FCC, or the FCC not being able to run at the rate that it should be. So that's another thing that people can point to. But I think it needs a headline for any kind of strength to come through, because it's just been like these OI decreases are like not a good sign.
I couldn't agree more. And I think, CTAs exist in RBOB as well, and gasoline. I think there's a lot of bearish like momentum drivers. But I think it's fair to say that if we're focusing on gasoline, we have had material stop outs. There was an article last week on Bluecrest letting go of a few traders. I think one of them gasoline, or a few of them gasoline maybe. And I think that's just indicative of quite a few of the hedge funds leaving. They've piled into the space, you know, having seen 2022 in particular, but also, you know, 2023 as well. And the problem with hedge funds coming in is, you know, you've got to think, what are they adding to the market? And I think when a new hedger comes into the market, it's really good because it's giving you liquidity, and it's also, a hedger shouldn't care about the movement of the price. They are there to fix the cash flow. So by definition, they're passive, and they don't want to lose money, but it's immaterial. It's against the physical. Whereas if you add a speculative trader, what you're doing is you're adding more money to put into a speculative position that's fighting for that hedge side liquidity or other speculative liquidity. So it's just more competition. So what you tend to get is basically more volatility, because and not the good type of volatility, not like nice smooth trends. You get very choppy moves because people are fighting for entries, and essentially it doesn't really help the market, because, well, it would actually help the market if there was diversification in thought. But I think the oil market is still in a state of, the majority of the volume that is traded speculative, if you take out CTAs, is based on analyzing supply and demand models that are looking forward, going out onto industry and finding a consensus with majors and trade houses and conferences, getting comfortable with that supply and demand view, and then putting that supply and demand view as a binary buy or sell. And that is a consensus mindset. So it's group think. So everyone's fighting for the same trades and feeling comfortable. It's herd trading. So herd trading has worked in 2022 and 2023 and 2021 actually. And it's just, you just hold it into pricing and everyone's helped support it. And the fundamentals have been there so that physical pricing at the very end of the contract's lifespan is able to give you that last support. But this time round, because it hasn't been there, you've now got a bunch of people who are got the same position, but now even more people because of the hedge funds piling in. So there's even more competition for the exit. And that is the worst scenario for a someone who's been trading the same way year in, year out. You add all this speculative froth and it's really painful. And so if anything, it's been great for momentum traders, but it's been horrible for, I think, the general speculative market. But anyway, I say all this to say the stop outs have been so public and so meaningful, and prices in gasoline relative to crude are so low now relative to where they were, that to your point about headlines, the closer we get to hurricane season and the potential summer demand, like Jorge says, the lower prices create more demand, and incremental price decreases have a huge impact on driver sentiment, especially driving season in the US. So they come into a $10 per barrel cheaper, which amounts to, divided by 42 cents per barrel to get it to gallons. That's going to have a material impact on their on the cost of their travel, and it probably will increase the chances that they do travel, and that's increased demand. And then you add to that a shock event like a hurricane or a refinery going out, and all of a sudden you've got a low price, you don't have the speculative froth, and you've got increased demand. So ironically, it could end up happening, but you don't, as you said, they as in the general people who've been stopped out don't have the appetite to buy into that anymore because they've been so burnt on it, which ironically makes it a good time.
Yeah, and I think like the lead lag thing that we're always talking about with the futures looking to the future in the past, the stats looking to the past, I think the headlines that we're seeing right now of we're going to see these progressive decreases at the pump for Memorial Day, July the 7th and Labor Day, that's almost like in the public sphere now, like, and when people see that they'll think, oh, maybe I'll drive, let's go. 100%. And then when the markets see those stats, maybe that'll be bullish, but I think it's going to take something a bit bigger than that. I mean, there hasn't been a great reaction to like the Nigerian strikes, and I thought that would have a bigger reaction, to be honest.
That was a wild card this year. Even though people have been talking about Dangote Refinery a lot, it seems like it has actually hurt the market sentiment into pricing at least. Yeah, and then you've got distillates, which is kind of similar, right? And then I guess there's a bit, people weren't really banking so much on gasoil being strong. It didn't seem, at least, it didn't seem like there was this huge consensus trade on gasoil being bullish this year, like it has been in the last 3 years before that. But that's also looking like it doesn't really have much in it, right? I mean, it's just as this weakness coming from the States. I think that the same with the, RBOB driving the prices of European gasoline, the heating oil is driving the weakness into the European market. We've seen European stocks fall in the ARA another week consecutively, went down by 61,000 metric tons last week, and it's done next to nothing to buoy prices. All of the weakness is coming from the States, and there just isn't that demand. There's no good heating demand, there's no good trucking demand, and I think that we're like kind of suffering on both sides of the barrel of this like light and heavy situation of just the US demand just being really poor. So it all points to essentially outright prices have probably been what's been disconnected. So that's what's left to go. It is starting to go. It's probably got a lot more to go, and once it does, and if I was trading right now, love bearish markets. They move aggressively and smooth downwards. They tend to, actually, people probably can test that. Maybe not so smooth, but it feels smooth because you sell, if you're aggressive in entering, you get quite an immediate return. And then you get choppiness, but you're already in the money. So you can kind of just ride it. And then you just continue to trade the momentum downwards. And if you have a generally consensus long market, which the oil market is in general, then when it comes down for a long time. And I always used to believe in overextension on the downside, not so much on the upside, because people are always talking about the next price, $180, $300. Whereas on the downside, people don't tend to do that until like very late on. So I would say if people are trying to predict 72, 73, I think risk reward being long 55 puts, for example, is really, really good, because it's just a massive overcorrection. You've got all this weight of selling and downward momentum, and you watch, the media will come out and start to build on these stories. Then the S&D fundamentalists will have to change and have to talk about how they were shocked about this, shocked about that, and they'll have to make a a shipping tanker type shift, which takes a while. And then once they do, they have to be clear that it's a down market for a long time. So they're now going to have to pile into a bearish narrative, which will, create a serious downward momentum. And then not to mention producer hedging, which hasn't been a big thing for a long time because it seems like markets have been stable on the upside. You talk about it now, you talk about the Saudis as one thing, but they don't really hedge. So you've got the US again. And we talked about this a lot this year. All the consolidation has meant for the derivative markets that you've got bigger companies who don't like to hedge. And all the independents that used to be systematically hedging and providing good sell side liquidity, but also protecting themselves, haven't been protecting themselves. So now we could have a serious rush of producer hedging the closer it gets to these break-even prices, which of course have been elevating over time with inflation and costs and the rest of it. So it could get quite ugly. The oil market doesn't just like nicely correct and go back up again. It boom and bust cycles. It's something that I don't think will ever change with oil markets. Do you concur, Jorge?
Absolutely. It's a feature of the markets that we all pile into the, as you mentioned before, the groupthink. And the groupthink this year and last year was that we are heading up and we are forgetting the increasing supply, the countries that add to that supply, the softness initially in Europe. We also forget the renewable impact. And this is something that most people in this world of oil don't talk about, and even I don't think much about. But a friend of mine was telling me that the Chinese company BYD just launched a car in Singapore, a hybrid, that with one gasoline fill up plus one charge can be used to drive from Singapore to Bangkok in one go. That's really a lot of efficiency in terms of hydrocarbon.
I did that journey when I was 18. That's quite a long way.
Yeah,
It's
and
like
they can do it in one charge and one fill up. That's the future. The future is here.
You're doing what I'm saying is in like you've now seen a downward move. Now everyone's going to talk about renewables.
Yes.
And then it's going to create the bearish sentiment.
Yes.
So, okay. Bearish, fine. A lot of bearish talk. But aside from that, Martha, is there any trade ideas aside from that?
Sell everything. Sell all the spreads. Sell all the flat
Hang on, let me
price.
give you an anecdote then. I think I did actually put this in my book, but I remember a trade house in 2014 when we had the big sell-off. And you say sell everything, but we trade a lot of differentials and time spreads and like that. So they thought the demand for jet fuel is going to be weak. There's too much production, da, da, da. So they sold jet diffs.
Ooh, yeah.
And they lost a lot of money because that was the wrong trade expression. When you sell jet diffs, the problem with that is when the outright prices go lower, airline hedges are more likely to come in and buy. And when they buy, they're looking at the outright. They don't care about the diff. So they kind of just price take. And so they're naturally creating a premium against the outright price because they're just coming in and locking it in. So the jet prices versus the gasoil diff or versus Brent actually went up because that extra $1 a barrel or so they weren't bothered about because they're capturing, a $20 saving by hedging. So it's not sell everything, Jorge. What do you think, Martha? Your trade idea.
The trade idea was to sell, but it's also to buy. It's to look to sell the WTI Brent diff, so selling crude in the US and buying the North Sea Brent. So this is actually quite a US-centric trade, and it's looking at lots of the factors that we've already kind of mentioned and looking at how precarious the situation in the States is with their production. Because the production is so landlocked and because they're so susceptible to short squeezes generally, I think this is always really important to keep an eye on their export capacity. Exports have been really strong recently, but production, as we've been saying for weeks now, has been crazy. And if there are these hurricanes and there can't be good exports, if there are these heat waves and their refinery utilization drops, I think that WTI could suffer very poorly. And then going back to what Vincent was saying earlier about the CFTC positioning, money managers are getting longer in the TI versus Brent diffs. There could be some not the diff, but like the difference between the two positionings. There could be saturation that further supports this and people kind of piling out positions. It's been really strong recently as well. I think over May it's increased a lot to like, I won't guess, but we'll get the graph on screen. I think it just would be an interesting thing, a good place to put some risk reward, I think.
I think it's a very smart trade, and the reason why is because assuming your risk appetite or you're already in a short position, let's just say, but you are bearish on a physical sense, that this is the trick. This is the problem with having a view that's based on physical. How best to express that? Well, really the only way to really capture it like for like is trading a time spread, because that settles to an actual physical premium on pricing, but everything else is a majority or highly a function of derivative flows. So with this trade, what I like about it is it is very fundamental, and it's obviously not a time spread, it's a spread between two contracts. But if you look back at the big sell-offs that have been structural, so physical changes, WTI Brent has just completely performed or underperformed or overperformed on the downside. So you've got 2020, obviously that's when we went negative in WTI. You've also got scenarios like 2012, I think. No, it was actually 2013, where WTI Brent was minus 24. And you had this the same old situation, which is it's the structure of, and Jorge will be very passionate about this, we've talked about it many times. Inherently, WTI is a landlocked based crude. It prices to crude that's inland, and if you can't get it out, the glut will be endless. Whereas Brent, you can obviously send out the cargoes. So whilst that is still in place, when you have a glut or a building glut, WTI Brent as a strategy is a very good trade. And I think you said about the exports, the US market is so used to factoring in exports, but they need to be absorbed. There's no point sending exports if no one's going to buy it. So what happens is if no one wants the oil, then the US have got to keep it. It's going to build stocks internally. It's going to build stocks in Cushing. And we're up to like 4 million barrels a day in US. That is enormous. So if you stop exporting some of that crude, or even let's say half of that crude, you're going to build up so aggressively. And so I really like it. And I think it's quite a good one. The only problem is the SPR announcement this morning. I think, the US did do a huge, 180 million barrel release to the market. If they're now going to buy that back, of which they've got, roughly 140 odd to buy back million barrels, that incremental demand, it will help to clear a potential glut. And I think that's undeniable. However, just on an export basis, I think it's a good trade. So, yeah.
Yeah, I would like to add something. The weather forecasters are feeling that there will be more hurricanes this season than normal.
Yeah, we've talked about this quite a lot, yeah.
And as that happens, the possibility of the export facilities being offline for some time increases. Therefore, if we're heading into a bear market, that magnifies the glut and the overhang in the landlocked areas. So we could expect a sharp widening of the Brent TI spread in October, say. Those are a bit of kind of like playing odds, but I think the odds are quite likely that it will happen.
And that's what Martha said, right? As a risk-reward trade, it's quite a safe trade because the upside doesn't seem great at all. You've got a market more long in WTI than our Brent in a bearish market. You've got a European market that cannot handle the crude. So it just doesn't make sense for that to strengthen too much, and it does make sense for it to weaken. It's actually very vulnerable, potentially very vulnerable. So the natural risk reward in that trade is good. Okay, we had a poll, as we always do, and that was about housing market, the US housing market. And most people said, we asked if it was overvalued, and most people said yes, it's overvalued by 10 to 30%. Yeah, that was pretty unanimous in that it was overvalued. So I don't think there's any arguing with that, especially from you guys. So just before we sign off, I think you have mentioned it, Jorge, but let's be clear about what you're up to. The officials, as you're calling it, the need for them. Let me just set you up, because it's you did such a fantastic job in your career developing this ecosystem, this pricing ecosystem that the whole oil market relies on. But as every market does, it evolves, and the next evolution was the derivative component to pricing, which has become so important. So that's what you're now focusing on.
Yeah, if we take a little bit of a historical view, there was the focus on the physical. And over time, the physicals created derivatives and futures and side markets. Those side markets grew to being maybe, I don't know, in one account I did 27 times the amount of the physical. And the effort by the publishing industry to focus on these very important derivative markets, all the cracks, spreads, boxes, very complicated things, is fairly minimal because their effort has been on the physical market. So there is an opening there. And as a company here, we have a view very sharp, very broad on those derivative values. And we have created a team that is independent from Onyx Trading that looks, reviews, analyzes, and decided to publish yesterday for the first time the officials publication that gives you all the derivative fair values for flat price, spreads, cracks, and boxes. So it is available on LinkedIn, and anybody who wants to subscribe to it, please let us know. We'll send you by email PDF, but I'm very happy to report that many thousands of people are looking at the output, and many majors, many trading houses are focusing on it. And it's great because very few companies in the world can say, we know where the price of all this derivative web of prices is, and we're one of them. So there you go. I think the time has come for that independent fair values publication, and there
on
we
the
are.
derivative side, which will in turn massively enhance the physical price as well, which is determined in part by derivatives.
Absolutely.
So it's very exciting, and who better in the world to do it? So this is really great.
Also available on onyxhub.co.
Nice plug there. I was just about to say we've got the onyxhub.co, which is up and thriving. That's articles, different types of articles, opinion pieces, just what's going on in the market. It's our media, of course, clips. There's dashboards analyzing refinery margins, stocks. There's a hell of a lot on there. So please go and check that out. And of course, check the new officials out there as well. Thanks everyone for listening, and see you again soon.